Good day, everyone. Welcome to another presentation where we attempt to bring money and meaning around your life and your legacy. When we think about retirement income, the first thing that comes to mind is your CPP, your OAS, your annuities, your RIF. However, your TFSA perhaps is more powerful and more useful than all of these. I'm going to be talking about 5 underutilized TFSA strategies that, if you took advantage of them, they can provide a very tax efficient and effective retirement plan for everyone. If you continue to use your TFSA during retirement, you can actually prevent clawbacks no matter how large your TFSA balance is. This gets us to the first underutilized strategy. For example, if you would like your retirement income to be, let's say, $70,000. Now, let's say you have $60,000 in RIFs, in annuity, in OAS, and also in CPP. You have $60,000 in all of these together. Now, in order to get to $70,000 without putting yourself in the higher tax bracket, the last thing that you would want to do is to take money out from your RIF. You take money out from your RIF, you're going to be pushed into a higher tax bracket. Now, if you take money out from your TFSA, remember, this does not count as income earned. You can actually take out $10,000 annually from your TFSA without affecting any tax brackets, and you have $70,000 in retirement income. So it's a great way to top up your retirement income in a tax efficient manner. The second way that you can use your TFSA is to put this into investments that have higher returns than the rate of inflation. Remember, when you retire, you may have 20 and 30 years ahead of you. So why not use your TFSA and put investments that will grow faster than the rate of inflation? This way, you have tax-free income also earning interest that grows faster than inflation. So it's basically like taking out water from a bucket. And when that bucket gets refilled, this is how it is like to have a TFSA with investments working for you. You see, a lot of people make the mistake of putting cash or investments that just sits there in the TFSA. Meanwhile, that you're taking out money, what happens is that your money is going. But if you put your TFSA, if you put investments in your TFSA that earns interest, think about it. You have tax efficient income that also grows faster than the rate of inflation. So your TFSA can retain its value over time, which is great for you. Third way in which you can take advantage of your TFSA is to reinvest strategically. Now, here is the good thing about a TFSA. You do not lose any contribution room. So let's say you withdrew $10,000 from a TFSA. That $10,000 will be added back to your contribution room in the following calendar year. If you took $10,000 out this year, you'll be added another $10,000 next year, right? So you never lose your contribution room. Even if you take out money from your TFSA, you can reinvest wisely. And also you can use your money for pretty much anything when it comes to emergencies, when it comes to investments, right? So withdraw and reinvest strategically. The fourth strategy is that you can delay your CPP. Think about it. If you use your TFSA, you can pretty much be more tax efficient, since the money that you use, you're not going to be paying taxes on. It's not going to increase your tax brackets. It's not going to force the clawbacks to your OAS. Meanwhile, you're delaying your CPP benefits. And when you delay your CPP until age 70, that means a larger CPP payout for you, right? So you can pretty much delay your CPP if you have a reasonable TFSA built up. The fifth way that you can actually take advantage of a TFSA is to legacy plan. Now, if you structure your TFSA correctly, you can actually transfer the death benefit to a beneficiary. You can select a beneficiary and you can roll it over into a beneficiary if you pass away. Your beneficiary receives all of the TFSA, all of your TFSA, basically that bypasses probate, right? So if you do it effectively, a TFSA could also be a great way for you to legacy plan and to pass it down to your spouse if you pass away. Bottom line is that with a tax-free savings account, remember, it is not how much money that you have, but it's how much of a tax-efficient manner that you can take advantage of it. If it is not part of your retirement, it should be a huge foundation. So I hope you guys have gotten insights onto this presentation. If you found value, remember to hit the like, subscribe, drop a comment down below. Until next time, peace and love, guys. Take care.